We are sick of hearing about interest rates. Hey guys, my name's Adam Panisi. Hit that subscribe button because I talk about making money in property so you can retire early on passive income and you don't have to chain yourself to the 30-year mortgage plan. I bought my first property when I was 22 years old and now I've got a few hundred investment properties on the go. I'll jump in and take you through this episode now. I'm going to show you where I think interest rates are going in 2024, and this is especially critical if you have money sitting in the bank, if you've got debt on other things, and especially if you own property or are about to get into the property market. Before I tell you exactly where interest rates are going in 2024, let's have a look at some of the key inputs and how I've made the conclusion that I have. And also stick around to the end of the video. I'll reveal when interest rates are going the direction that they're going and what this is going to mean for the property market. With interest rates, everybody's looking at the level of inflation. So in December 2022, we had 8.4% inflation on the previous year. And then as you track beyond December 2022, you can see the graph went down to this one, 6.3% in March 2023, and then we've gradually come down. July 2023, we're at 4.9%, then we spiked again and everyone got worried. But now we're down at 3.4% with the monthly CPI indicator, which is inflation. Now we've had 2 months running at 3.4% when I'm recording this video. So that is to January 2024, we're at 3.4%. Remember that the RBA's target bandwidth is between 2 to 3%, which means we're nearly in that bracket. And if you have a look at previous years when the market was slow, the economy was sluggish, you can see even before COVID, we were only tracking at sub 2% in terms of the CPI indicator. So what is that going to mean for interest rates in 2024? I'll show you some other stats. Another key stat which the RBA looks at before they adjust interest rates up or down is they check what the rest of the economy is doing to make sure they don't break it or to make sure we don't have inflation running through the roof like what's happened. In other words, people are spending too much money. So this is a retail sales volume turnover, and all you want to look for, or what I personally look for, is a trend to make sure that we haven't spiked in retail sales volumes, which means that people are going out and they're spending a whole lot of money, which means they're saving less. So they're stimulating the economy too much if this graph spikes. We've looked at one side of the equation, how much people are spending, and that was pretty consistent. Now let's have a look at the other side of the equation, how much are people actually saving? And you can see the household savings ratio has dwindled right down because people are spending less money in the economy on retail sales. But the other part of the equation is that as interest rates moved up, we were spending more money servicing debt than we were on putting it back into our bank account. You can see from September 2021, it's dwindled away. People started spending, but then when interest rates started to rise around about mid-2022, was the first interest rate rise. So you can see June 2022, we had a household savings ratio of 7.3%, but now it's dwindled all the way down to 3.2%. I'm going to show you the GDP, or gross domestic product. This is a consideration when looking at the overall economy of Australia. The GDP needs to be positive, which means the economy is growing. That's fairly normal. Once it starts to go into negative territory, that's when the economy starts to contract, and a couple of periods of negative growth means that we're in a technical recession. So we're not in a recession just yet, but it looks like we are going to start to experience some negative growth very soon. So we're just going to look at this bar graph, and this is the quarterly growth on the GDP. So you can see the last little bit from December 2022, it started to taper away, and we've been getting lower quarterly growth volumes. And you might have just seen this in the media now recently, or you might have seen it over the last 12 months, that our quarterly growth is actually lower than our forecast. So we should be running at around about 3 or 4% is fairly normal for annual growth, which means this number should be at 1% or even half a percent. And the last little bit, it's 0.2%, 0.3, 0.5, 0.6, 0.8. So that is contracting, which means the overall economy is not growing as fast as what it should be or what we anticipate it to be. And once we start to go into this negative growth, so you can see this quarterly growth in this period of September 21 was negative 2%. In the middle of COVID, it was negative 6.9%. So once you start to have a couple of quarters of negative growth, that's when you're in a technical recession. So we haven't hit recession yet, and I don't think we are going to hit a recession. We will avoid it. But what that means is we're coming up to low quarterly growth, so low GDP volumes, which means that there's going to be more pressure on reducing interest rates very soon. And this shows the policy rate expectations from the monetary policy paper that was released in February this year. And it shows basically every country, including Australia, having to now reduce their interest rates. So I haven't even looked at the overseas economies and how they're performing. We're just focused on Australia. But what you can see is we're headed for a downward trajectory in the interest rate cycle. So we have peaked. Interest rates are not going to go up again, according to all the stats I've just showed you. And according to this monetary policy, it looks like we're headed in the right direction. Now it's just a matter of timing. When exactly is this going to happen? My crystal ball is at the back end of 2024, in the last quarter, we will see interest rates reduce. And I think they will do that just in time before we break the economy, and we'll hopefully get it back on track. Now, what this is going to mean with property is that everyone's going to be waiting to jump into the market when interest rates start coming down. It means that people are going to be able to afford property more easily because their borrowing power is going to increase. And the banks are also going to be more bullish on lending money because they're going to have seen that the interest rate cycle has actually now finished and now it's declining. So those big buffers that the banks apply to your borrowing power, they're going to reduce those to be less. And that is going to mean we all have more money to spend and we can borrow more money at a cheaper rate. So buckle up and get ready for the next biggest property boom in some key locations. Follow for more. I'm going to do some videos on where to buy in what capital cities to take the best advantage of this interest rate reduction.